Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jon Ferro, along with Lisa Abramowicz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. Roland of John Hancock Investment Management writing this. We are not chasing the bad news is good news narrative. Eventually, bad news will just be bad news. Emily joins us now for more. Emily, how close are we to that point? Are we at that point right now?
Well, to your point, John, it's just been a couple of days here, but there's been some pretty notable cross-asset trends. We look at things like small cap equities. Yesterday, they were down over 1%, even with that decline in yields. Over the past month, we've seen the 10-year Treasury yield decline from 4.70 to 4.35, and small caps have not kept up with their large cap counterparts. Of course, the narrative that's been permeating the markets is small caps should be the biggest beneficiary of rates coming down because they have higher interest burdens. And as the cost of capital comes down, that'll be a positive for those small cap stocks that tend to be less profitable. We're just not seeing that play out. We're seeing cyclical stocks get hurt. So we're feeling kind of sniffs of the market reacting to, hey, maybe this isn't so great, and that the Fed pivoting is actually maybe not going to be for the best reason.
We're in new territory, and I need your help navigating it, Emily. I'm trying to work out the distinction between a welcome cooling in the data and an unwelcome deterioration. What does that look like come Friday?
Yeah, it's really tough. And I think it's right to be watching the labor market because we've seen some cracks forming. You mentioned the JOLTS job openings data this week falling to the lowest level since 2021. The labor market continues to normalize. The whisper numbers lower than that 180,000 consensus view on job gains this month. I think we could see jobs kind of join the string of weaker than expected data. We've had retail sales. Look at the Atlanta Fed GDP Now estimate. It was over 4% pretty recently for Q2, and now we're at 1.8%. So we're seeing a notable deceleration in the data. Now, if you look overseas, those economies are actually looking a little bit better than expected. So the U.S. may sort of draft off of better growth in areas like Europe. China PMIs overnight showed some strengthening. But we're going to have to see kind of when that point is. And I think looking at things like initial claims are going to give us a sense.
How do you understand the Fed's policy and sort of their response function at a time where you really codified a pivot party and you talked about how it was fueling a lot of the gains in markets? Maybe the Fed wasn't wrong to pivot. Maybe they're going to cut rates in July. This is the assumption of the likes of Andrew Hollenhorst and Steve Englander. Do you think that looks increasingly appropriate, that maybe they were onto something about a weakening in the economy?
Yeah, Lisa, we think they were onto something, but the party just started way too early. I don't know if you remember kegs and eggs back in our sorority days. Maybe you guys recall that. But, back in October, the Fed hinted at 3 cuts, and then I just thought of that. And then, the bond market extrapolated that to price in 6 cuts. So the party started a little bit early. And I think the challenge with that was that you had this massive loosening in financial conditions. You saw risk-taking take hold, and the better economic growth was a good thing, but it comes with a nasty side effect of higher inflation. And I think you saw that in the form of the resilience across the housing market, especially in the first quarter. So the Fed's got a challenge on their hands. Yes, inflation's coming down, but it's taking a lot longer than expected thanks to the Fed's own sort of rhetoric back in the fall. So the Fed's sort of backed in a corner here. I think wage growth on Friday is going to give us some more clues on the inflationary backdrop, but it's probably going to be a little while here until we can see those cuts.
You're raising an interesting point about some of the optimism that was baked in that needs to come out. Where does it need to come out in particular in markets where you're looking at quality stocks, you're trying to stay away from cyclicals, and we're defining what does quality mean at a time where Nvidia to the moon trades like a meme stock and yet seems to be the biggest winner always?
Yeah, you've got to focus on the earnings, Lisa, in our opinion, and we would be looking to trim areas that are not profitable. We talked about small caps already. We would be fading that and continuing to lean into quality. We want to own companies with great balance sheets, lots of cash, but we also want to think about owning them at a reasonable price. You know, you mentioned technology companies. Yes, the valuations are looking somewhat extreme. No late 1990s, but they're looking overbought, but the earnings are there. You look at NVIDIA, yes, the stock's up a lot, but the earnings are up over 400% year over year. So you've got to find those quality companies. We're finding it mostly in U.S. mega cap tech, communication services. We'd even be sprinkling in a little bit of utilities now to balance out that tech exposure.
We'll speak to Lizanne Saunders a little bit later, Lisa, of Charles Schwab. NVIDIA's correlation to the market was 0.95. It's now 0.3.
Oh, yeah.
What a change.
I mean, essentially, NVIDIA is no longer the market in the same kind of way. It's interesting. Emily was talking about 1999. Washington Crossing advisors, Chad Morganlander and Kevin Karen, came out and said, in both 1999 and today, the stock market exhibits strong momentum and herd mentality, particularly among, that's right, the largest, most valuable companies. So some people are drawing the analogy with 1999 in a more aggressive way.
What do you make, Emily, of that breakdown of the correlation between NVIDIA and the broader market?
Yeah, we think it's healthy. You know, again, you're seeing a bit of a broadening out here. Some more breadth is certainly a good thing. You know, it was time for those names to maybe take a little bit of a breather in terms of their dominance. It's still there. And again, it's a key reason for our emphasis on U.S. versus international equities, just that the fact that we have a massive exposure to tech here. That's where we're finding the most quality. But we would also be looking at areas like mid-cap stocks. If you look at the S&P 400 index, it's actually trading at the steepest discount to its large cap counterparts since the late 1990s right now. So we think that there's a nice opportunity to lean into mid-cap stocks, take advantage of that valuation discount, and also get exposure to areas like industrials, which are benefiting from onshoring and industrial production that's picking up in the United States.
Emily, help me out here. So basically, we start the conversation by talking about bad news is bad news and end it by saying lean into mid-caps. Can you make that work for us?
Yeah, so we're balancing that out, John. You know that we've also had an overweight to high-quality bonds here. We love the fact that bonds are giving you income, 5-6% income. Even if you've got to wait a little bit for the duration tailwind to kick in, you're still collecting income in an environment where we do think economic contraction's coming. It's hard to see it right now, so we want to maintain exposure to areas that are benefiting from fiscal spending that's going on. We're finding that in mid-cap equities. We want to have some offense in the portfolio, but we're balancing that out by collecting 5-6% income here in high-quality bonds. We like that trade, too.
Just before you go, can you tell us how important you think that ISM services number is a little bit later this morning, particularly given what we saw on Monday?
Yeah, I think it's very important. Markets are very sensitive to that right now. Retail sales disappointed. We are seeing cracks in the consumer. So we're going to need to see, how that side of the economy holds in here in a time where a lot of people are pushing back on higher prices.
Emily, thank you. Emily Roland there of John Hancock Investment Management. Bring in the panel, Tom Porcelli of PGIM, alongside BlackRock's Marilyn Watson. Marilyn, first to you. Let's go to the calendar. Later on this morning, we all know what we're looking for, ISM services. Do you expect that to confirm some of the weakness we've seen so far this week?
So as Michael McKee said, the data has become so highly scrutinized that we've seen quite big moves on very small amounts of data. In terms of the ISM, we actually think it's going to continue to show a relatively robust economy, particularly in terms of services. And so we think it's going to continue to show that actually, as most of the data is showing, that actually the economy is normalizing, it is decelerating, but in a sort of a bumpy way. So we're not taking too much store by the ISM today. Obviously, we have payrolls tomorrow. We have CPI next week, along with the FOMC, and there's plenty of data to come in the next few weeks as well. But we think that ISM is going to continue to show that actually overall the US economy remains relatively resilient.
Tom, we've heard that word so many times in the last 24 hours, normalizing.
Yeah.
What is the distinction between a welcome cooling and an unwelcome deterioration?
Yeah, and I think this is the challenge for the Fed, right? Because I think it's really easy. I think the stat you highlighted, Jonathan, is spot on, right? If you look at the ratio of openings to unemployed, you're basically back to where you were pre-COVID. But what keeps it there? And I think what would actually help keep it there is for the Fed to start the process of removing some of the tightening. And I think that's the real sort of real challenge for them. I mean, when I look at, it's funny, the QCEW, which you mentioned earlier, to me, this is like one of these great metrics that no one really pays attention to. I mean, and if you take it at face value, which is basically used in the benchmark, right, revision for payrolls, you know, it would suggest up to, you know, 50,000 less jobs per month, right, last year. And that's not a small thing. And again, the smoothing of that is a little trickier. But again, just taking it at face value, I think it suggests that you're going to look at actually some lower numbers in for last year. But I think thinking about where we are right now, I think what we have to keep in mind is there are an assortment of data that actually are suggesting that things are looking a little softer from a labor market perspective. Now, look, let me hasten to add, I think on Friday, I think you could probably see about 200,000 jobs being created. But when I look at something like, you know, the small business survey, you know, hiring intentions there, which, by the way, is comporting with actual data, hard data on what small business are doing from a hiring perspective, which is to say it is lower. If I look at you know, something like the labor differential from the Conference Board, which is also deteriorating, which again, soft data, which is comporting with the hard data. The unemployment rate is up modestly, but it's up. So there are things that are actually suggesting that labor is slowing, and I think this is where the Fed comes into play, and I think this is why the Fed wants to start the process of taking back some of that tightening that they put in place.
Messy data was blamed for what some people say was a Fed error in 2022 of not hiking rates sooner. Do you think, looking back, that some of the messy data that's going to be revised heavily will be viewed as the reason for another Fed error, that they didn't cut soon enough?
And Lisa, I think that this is what's on the Fed's mind at this point, and I think this is why they actually want to start. Look, I think if we just take a step back, I think it's very easy to say that, you know, you think about Powell and what they were trying to achieve. They stopped hiking rates in July when core was at 4.2%. I think that whole process, that whole thought process was built around, let's try to limit the downside from a labor market perspective as much as we can. And so I think that's already on their minds. And I think this is why the conversation of, hey, let's cut is happening even with, you know, 2.8% core PCE.
Marilyn, this uncertainty really has led to this question of the incredible volatility that we've seen in markets and how things have been ping-ponging along with the narratives. You focus on flexibility and liquidity. Is that because you want to move on a dime in response to some of these data points?
It's because we think there are a huge number of opportunities out there, particularly in fixed income right now. You can lock in very, very attractive all-in yields, very attractive carry with very good liquidity and, you know, limited duration risk. But that being said, it's a very uncertain time in terms of the Fed. You know, we do think they may start to cut rates at some point this year, but it's too early right now, we think, to tell exactly when. Likewise, we do have, you know, obviously the ECB, we think are very likely to cut rates tomorrow, and then they're most likely to be data dependent as well. Bank of England may cut rates at some point in the near future, and again, will be very data dependent. And I think, as you say, a lot of the data is becoming sort of, as you say, quite messy. And as we do see this normalization and two-way risk coming in a lot of the data, whether it's the labor market, whether it's other economic activity such as manufacturing, consumption, retail sales, you name it. And so we do think it's important that we are flexible, that we can actually, you know, deploy money where we think we see the best opportunities. We want to lock in the best income that we can for clients, but we also want to protect against outside events. And as you say, we don't know a catalyst for, you know, the data to really swing dramatically one way or the other, but we want to be prepared, and we think that's very, very prudent at this stage in managing the portfolio. We want to be very, very risk aware, and we really want to understand exactly where the risks are in each position that we have, and, you know, be aware that we can change portfolios if we think necessary.
Talk to us about how to confront this negative yield curve, this inverted yield curve. 2-year, 10-year, negative 45 basis points. You're talking about normalization. You're not talking about deterioration. You're talking about 1 or 2 rate cuts. We're not talking about deep rate cutting cycles. So what is the argument for people out there who are looking at a 2-year that gives me 480 and a 10-year that offers 432? Why would I extend duration, go out along the curve? What's the reason for that?
So I think certainly in the US and the in the Treasury market, it's hard to really give a good reason why you would go out the curve, particularly sort of between 10 and 30 years. It's hard to see a good rationale for taking that duration risk, as you say, when you can get better carry at the front end. And particularly, as say, for the front end, if we do start to maybe hear a little bit more from the Fed, maybe potentially to cut rates potentially this year, then you could see, a little bit of a shift down in yields in the front end in particular. But as I say, the curve is very inverted, and it's hard to see yet a reason for taking duration further out the curve then. That being said, when you look at investment grade, when you look at other areas of the global bond market, then we think it does make sense to take a bit more duration risk. So, for example, in the UK, we're overweight duration in areas of the Eurozone, IG corporates. We have added a little bit more duration risk there as well. But I think it's about being very, very tactical and very specific about where you choose to take that duration risk.
This is a fascinating point, Tom. I'd love your take on it in terms of, higher yields in the U.S. over the long term. Why? Is it because of inflation, or is it because of something else?
And I think that this is where the context part of the conversation comes into play, right? Because, in fact, I think we talked about this on when I was on last. I hate the idea higher for longer. It's not higher for longer. It's normal for longer, right? I mean, I think, to me, I've been saying this for a long time, and I think that that's really where we are. If you look at like 100 years worth of yield data, the outlier was the prior 10 years. Otherwise, you're in this sort of like 3 to 5% zone. So to me, again, and if we're right that, the Fed does cut rates, but this is going to be one of these, sort of fairly modest easing cycles, that idea remains true, this sort of normal for longer.
Were you trying to start a Liz Truss conversation again?
I wasn't trying to. I'm just, this is sort of the question, right? I mean, there's also a question of buyer base. And actually, Marilyn wrote about this, about Japanese buyers and what happens if you end up with bank. Seriously, it's
just so you know, I can read it. Knew where you were going. Marilyn wants in now. Marilyn, your thoughts, please.
Excuse me.
So, I mean, we certainly think that rates will remain higher than the market expected and higher than they have been for a long time. So even as the Fed does start to cut and as the ECB starts to cut, we think it's going to be very, very gradual. And as you know, there's been a huge debate around where our star is. We need to see inflation come down in a sustainable way towards, the various central banks' targets. And it's not there yet in most cases. And so we do think that rates will remain higher than they have been for quite some time, and certainly higher than has been expected both by the central banks themselves, whether it's the summary of economic projections or other things as well, than maybe and also certainly than the market had been anticipated.
Marilyn, this was great. Marilyn Watson there of BlackRock, alongside PGIM's Tom Porcelli. We begin with our top story, cooling labour market data reinforcing speculation the Fed will cut rates this year. Bob Diamond of Atlas Merchant Capital saying the market has caught up to reality on Fed rate cuts, saying, quote, any cuts they make in the second half will be minor. Bob joins us now for more. Bob, good morning.
Good morning, Jonathan.
The market's moved towards you. They were looking for 6 cuts this year. It was ridiculous. We're now looking for like 1 or 2. Can we just start with what you think of the recent economic data, the information we've sort of got our hands around over the last couple of days?
I think it's consistent with what we're seeing in the whole first half, which is if you look at the second half last year, then the numbers coming out were a little bit pleasing for economic growth, probably a little bit pleasing for inflation being lower than we expected, and the labor market continued to be very robust. You get into the first half of this year, and the economic numbers are probably a little bit weaker than we thought. The inflation numbers are a little bit higher than we had anticipated. And for the first time, we're seeing just a little bit of looseness in the labor market. I don't want to overstate that because I think, the labor market is still in very good shape. But I think in both cases, the economy is strong second half last year, you can't cut. Inflation a little bit higher than you want this half, you really can't cut. So, Jonathan, I think 25 basis points here or there, who knows, right? There's no precision in this. But by and large, I think the risk for the Fed, the risk for the chairman, is to cut too early, before there's any economic weakness, and then having to reverse course as inflation, begins to grow. So my sense is they're going to be patient. They're going to be, everyone's used this word data dependent, but until we see a weakness in the economy or inflation really down to 2%, then they're just not going to cut.
Both the economy and the market have surprised a lot of people. I talked about expectations in January, where we were then, where we are now. Let's talk about where we were last spring.
Yeah.
Last spring, if we were sat around this table, the majority of people were speaking to Lisa, to me, to Anne-Marie, and they were telling us that what we're going to see is a real tightening of financial conditions. Banks won't be able to lend as much anymore. Companies are going to suffer.
Yeah.
Here we are 12 months later, credit spreads are super, super tight. And credit availability, particularly for large companies, is there and ready for everyone, even with rates of 5.5%. You've got your finger on the pulse of this. Have you been surprised by that, the availability of credit to this economy still with interest rates where they are?
By and large, no. And I think sometimes there's an advantage to travel. A lot of times there's not. But I spend a fair amount of time in the Middle East and in Asia. And when you listen to people there looking at what's going on in the U.S., it was, okay, waited too long on taming inflation, raised rates 550 basis points in 9 months. We all know the economy is going to collapse, and it's kind of like, really? Like, the economy is still there, the labor market's still there, and it's so clear to me that we have such a competitive advantage in this country with the depth and breadth of the financial services industry, and I think it's a real asset. Europe doesn't have it. China doesn't have it. Hedge funds, venture capital, private credit, all of these ways to get credit into the economy, into small businesses, into middle market businesses. We have many investments with Cascadia in Seattle and Austin, with Marshberry in Cleveland, investing in advisory platforms for middle market in family-owned businesses. And it is incredible how many angles we have to get credit out into the economy in this country relative to other countries. And I think it has, I think looking at the U.S. from outside, there's real admiration for how did we manage this with 550 basis points in 9 months and the economy has stayed relatively stable.
There also is a question underpinning that, which is how effective is Fed policy and really having any influence whatsoever on credit growth, et cetera. There's a theory that the economy has just been a whole lot more resilient to rates as they go up to 5.5%. Is anyone talking about how rate cuts won't necessarily have any effect whatsoever on the economy also, especially just peripheral ones, because of all of this credit creation already in the system?
I think there's a lot of people that have an axe to grind. If you're in commercial real estate, you want to see rates come down for kind of the sector that you're in. But you mentioned history, Jonathan. Yeah. If we take a more historical look, since 2008, the great financial crisis, 2008 until the Fed started raising rates, Fed funds averaged just under 1%. If you look at 2, 3, 4 decades prior to 2008, Fed funds would have averaged about 4%. So I think we're in a much more normal environment right now. And I think the worst thing that could happen is that we saw the Fed, if the Fed starts aggressively cutting rates, it's going to be because the economy is weak. And so that's not necessarily good news. So we're not rooting for Fed rate cuts, but we do think, if you look out over the next couple of years, rates in the 4 to 4.5%, 4.5 to 5% range is probably the logical explanation. A bit lower than here over time, but not below 4%.
We've been talking about is good news, bad news, bad news, bad news, bad news, good news. For smaller companies, it has been bad news regardless, it seems like, over the past couple of weeks. And for small banks, regional banks as well, in particular, the KBW index is down some 12% on the year, really down sharply over the past couple of sessions. Do you think that rate cuts will eventually be positive for these shares, or do you think that there's some sort of structural issues with holdings and other potential challenges that just make it bad news is bad news for them no matter what?
We have a strategy to invest in regional banks, so I do have a bias here. We see a great opportunity, and kind of if you turn that on its head and say you're a strong regional bank, you've addressed your capital issues, and we all know that higher interest rates were impacting their treasury portfolios, as they have for every bank, and they've impacted loan provisions. But let's just, pick an example of an investor like us investing in a strong regional bank, so the capital levels are fine, there's no issues with a portfolio, and then look forward. you're really doing well with interest rates at this level. Higher interest rates are really good for banks. And it's been a long time since we've seen loan demand like this. So the go-forward position for a strong regional bank is actually outstanding. The question is, will we see consolidation, which we believe we will, and are there strong banks, which we believe there are? Okay. And I think one of the great attributes for again, you go back to the depth and breadth of the financial services industry in the U.S., the fact that we have these regional and community banks providing a service that the larger banks can't to small family businesses is a real strength.
You talk about consolidation. I wonder how much is going to be consolidation and how much is going to be failures. Yesterday, there was Access Financial, the latest potential target of some bad research, and a lot of it stemmed around its commercial real estate holdings. Some people argue that lower rates will actually cause property prices to go down because it will allow more sales to kind of get unleashed in the market. Do you think that there's going to be a rash of failures, that basically it's sort of like people sniffing out cockroaches, and if they smell something that's not okay, they just pull their money, and it's sort of a self-fulfilling prophecy? Do you expect that kind of activity to sort of come back?
Well, I think in our view, one thing that is certain is that since 2008, when the regulators and the political leaders claimed that we will never see too big to fail again, the larger banks in the U.S. have gotten bigger, more concentrated, closer to government, and far more systemic. So they're safe. The economy is good. But it's in no one's interest to allow the larger banks to continue to acquire the smaller banks. What we think is appropriate is that we strengthen some of the strong regional banks, whether that it's the capital markets, whether it's Atlas Merchant Capital doing investments, to give them the capital levels that are necessary for them to acquire some of the banks that I think are too small to succeed. Really, really good banks that have been more like community banks that have had good, solid ROEs for decades. But in this environment with the shock in rates, they have to adjust their treasury portfolio. With the loan loss provisions, they have to adjust that. And the thing that is more permanent is the regulatory intrusion post-SVB will increase their costs around technology and KYC. So we do see an environment where consolidation is a positive and a natural as opposed to weekend failures and big banks taking them over at the last second.
We started this conversation by talking about some of the misconceptions people had from the outside looking in, from outside of America looking inside America. From inside the financial system, what do you think is the biggest misconception that people in Washington have about the world you work in?
I think they misunderstand what has happened over the last 14, 15 years since the financial crisis with larger, more concentrated, more systemic, the big four, the big eight, if you look at the top banks. I think, between the top 2 or 3 banks of Wells Fargo and Bank of America and JP Morgan, it's over 50% of the deposits. And we saw a recent report where if you take 4,500 banks in the U.S., JP Morgan alone is 20% of the profitability. So banks are more concentrated. And I think what they're missing is the value to the economy of having a strong, robust regional and community banking sector. And I think for us, that is an opportunity over the next couple of years. And I think the thing that is really, really key here that people miss is the go forward. If you are a healthy bank, the go forward with higher interest rates and loan demand is outstanding. The question is, are you ready to be investing and are you ready to be lending?
Precisely. What's the starting point? Bob, you're going to stick with us. Bob Diamond.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.